here. Meteoric moves indeed, but first on the markets side, obviously, I think 2022 was a year with an incredibly challenging backdrop. The war, inflation, monetary tightening, so many external shocks at the same time. And I think before that backdrop for us, producing the second best result in our history has been great. I think the way we are configured as a business, we want to be resilient across the cycle. We want to be able to withstand external currents, be it geopolitical currents, be it macroeconomic currents or industry currents. I think we've demonstrated that again last year, and that gives me a lot of confidence for 2023.
Look, I've said it many times on this show that your valuation on a price-to-book valuation is way above 99% of stocks listed in Europe as well. The problem is, Philipp, they all want a slice of your pie. They all want your HNWs. They all want to do what you do with wealth as well. How tough do you expect the competitive environment to be with that in mind?
The competitive environment has always been challenging. Let's make no mistake. And I think still today, I think wealth management is not as easy as it looks. Yes, everyone wants to be there, but not everyone is doing it as well. And I think there are elements, obviously, of clients, of proximity. There's a revenue generation, which is critical in this field. And we will see how this will play out in the longer term again, now that the big rate hikes are over. And then there's an element of structural cost control, I think, where we have strongly delivered over the last few years. I think, again, we're in a unique position as a pure play wealth manager, but also compared in the industry in a very strong position for the coming years.
Philipp, can I get into that market volatility and just peel into some of these numbers? Assets under management decreased by 58 billion Swissy, that's down 12%. And you point the finger directly at the significant corrections in equity markets and bond markets. But, you know, we've rallied hard in Europe in January. We've rallied on those US market indices. A lot of investment managers are talking about how great the bond market looks like at this point. So what's ahead from here? Does it look like it's going to be upside because of those factors?
I mean, 23 is starting quite differently from 22. I would agree to that. And maybe it's too early to call this just a straight line, but I think the major corrections on the asset sides are over. The actually analyzed inflation range, if you look at the 3 and the 6 month inflation, is now already coming into target range. The headline numbers obviously are trailing and are still high. And I think it will be hard to cause a recession in 2023 when the private sector is actually in quite good health. So I'm cautiously optimistic. I think there's still some uncertainty and investors will still look for clarity as they go into the year. But 23 clearly starts better than 22.
Philipp, as you point to some of the uncertainty, is policy error one of them? I mean, there's a big debate still raging as to whether the Fed has it right, whether it could be over-tightening at this point, given that some of the signals in the economy are starting to weaken.
That's one of the things that could go wrong. I think this time the central banks will have to decide between growth and inflation. And it's a narrow path. The other thing that could happen is that households just save for too long, especially the US consumer. But bar these two things, I think, again, the road should be clear for a more constructive 23.
In terms of your cost base, Philipp, as well, and attracting talent as well, again, we know that there are major reorganisations going on. Some parts of, dare I say it, rival businesses are scything jobs. Others are trying to build up. Are you finding that your cost-income ratio, and especially the bidding war for talent, is intensifying?
I mean, the cost-income ratio has always been in focus for us. And as I said, through revenues and through costs, structural cost management has been important. And we've done our homework over the last few years. You remember we were at 67 back in 19, coming down now to below our target actually at the end of this phase. That's great. It doesn't stop here. We clearly said that we want to make further advances there and continue our industry leadership in the coming years. The hiring market has always been competitive. We're able to pay our talent in a competitive, but also in an entrepreneurial way, aligning the interests of all stakeholders and our shareholders with the relationship managers. And I think I have a lot of confidence that we're structurally very well positioned also to weather further storms in the coming years.